Our youngest has been trading on Robinhood now for a couple of months, and it's been a bit of, let's say, an eventful experience. But that's for another episode that Kate and I are putting together. Shortly after Joe Biden had his poor performance in the debate with Donald Trump,
That was
he
June 2024.
Yes, yes. He came to me, our youngest, that is, not Joe Biden. He came to me and he asked, "What is this good news now that we are more likely to have a Republican as a president? Does this mean that the stock market is going to do well?" I didn't necessarily agree with where he was coming from, but I was proud of him for even thinking in this direction. So, what do you think, Kate?
That's a question of interest to many. Actually, Adam, the guy who was remodeling our bathroom, which was supposed to take 2 months and took like close to a year, but that's also another story, asked me, do American firms and the economy do better under Republican or Democrat presidents?
Welcome to Questions in Finance.
A podcast where we translate academic mumbo jumbo to answer interesting questions in finance. I'm Kate Holland.
And I'm Veljko Fotak. Kate and I met when we were PhD students at the University of Oklahoma.
Today, we're university professors, and we spend our days teaching and researching companies, markets, and all things related.
When we're looking for topics for our podcast, our golden standard is really something that academia understands well and something where academia has an interesting and clear contribution, but at the same time, something that is not necessarily translating or percolating to the general public. And here, I think we're hitting the sweet spot because there is a very important disconnect. On one side, we have a lot of evidence that the economy does seem to be performing better under Democrat presidents. And with the economy, we mean macro. We're going to be looking at things like GDP growth and other big picture statistics. We mean firms, firm profitability, and other metrics, but also ultimately that translates into higher stock market performance. And we can discuss the strength and robustness of some of these findings and discuss some of the underlying causes. But here comes the disconnect. When you ask people who does a better job at managing the economy, is it Democrats or Republicans? Most respondents rate Republicans as better stewards of the economy. I did a little bit of digging here, surveys, opinion polls, and you can pick different times, different dates. The picture is fairly consistent. I had to pick one, so I'm looking at an NBC poll dated September 2023. 49% of respondents said they trust Republicans more when it comes to the management of the economy. 28% of respondents trust Democrats more. So that is a whole 21 percentage point gap between the two parties. Now, to put this a little bit more into context, in general, Republicans tend to poll higher with things like border security, national security, and crime. Democrats tend to poll higher when it comes to things like healthcare and education. But here we see a very consistent Republican advantage when it comes to the economy. The evidence of performance is at the presidential level. The opinion polls here are vague, right? They say Democrats or Republicans in a general sense, but this greater faith in Republican management of the economy does seem to translate at the presidential level. I have a Washington Post ABC joint poll dated August 2024 that gives Donald Trump a 10 percentage point advantage over Kamala Harris on the management of the economy. One additional interesting thing here is that in this particular poll, 90% of respondents indicate that the economy is the most important issue when they're deciding how to vote. And this is also something fairly consistent in other polls. So I will also mention that I looked at a little bit at how this opinion gap evolves over time. Republicans have had a substantial advantage on the management of the economy since 2010. If you go back to the period 1990 to 2010, Democrats were actually rating higher before 1990, it flips again, and again it is Republicans. Now, as we said, this is an issue that is somehow misunderstood, but also one that seems to be driving electoral decisions, which is why I think it's so important and why I'm so excited about this being the topic of today's conversation, Kate.
What is going to make this really interesting is we're really going to talk today about something that's known as a presidential puzzle. Literature that shows that a variety of actual outcomes when we're talking about economic growth, such as GDP growth, or stock markets, or corporate performance, corporate outcomes, such as sales and expenses, they're actually better under Democrat presidents. So it's puzzling that polling comes up so strong in support of Republican influence on the economy being more positive. But when we look at the empirical findings, we see the opposite. We see that the actual economic performance, corporate performance, stock market returns are all higher during Democrat presidencies. So it's a puzzle, obviously, because of this tension. And it's also a puzzle because while this has been very consistently documented, uh, that economic performance and stock markets do better under Democrat presidents, we are still looking for an explanation about why is that the case. So this is why it remains a puzzle, so to say. And today we're going to take a look at this puzzle. We should mention that we're going to be talking about US presidential elections specifically and not dwelling too much into state level or mayor level elections.
And I think those are important qualifiers. Thanks, Kate. It's a puzzle, as you say, partially because we are yet short of a good explanation, and we're going to go through the proposed ones. But on the other side, I think it's a puzzle also because this seems to challenge our preconceived notions in many ways. Right? I think many of us come at this with the idea that Republicans are the party of low corporate taxation. Republicans are the party of deregulation. Republicans in general have done a very good job at marketing themselves as the pro business party. So I think this finding that the economy and firms in particular do better under Democrat presidencies will surprise many. And that's part of why I would define it as an interesting puzzle.
I think that adding to this is also the fact that whenever you look at stock market returns around Republican wins, it seems that the stock market reacts more positively to a Republican win. Of course, it could be linked to the tax expectations that you're discussing because taxes are generally lower during Republican presidencies. But the initial stock market reaction is more positive. It turns out that it's the later years, years 2 and 3 of the presidencies, that flip, and the performance across a broad range of categories is better under Democrat, not Republican presidencies.
You're absolutely right. Even before Republicans or somebody on the right wins an election, there are reactions by the market. And again, I think that these reactions show that this issue is not just misunderstood by the public at large, it's also misunderstood by financial markets, or rather by the people who professionally manage money. We have a paper by Snowberg, Wolfers, and Zitzowitz. This was published in the Quarterly Journal of Economics in 2007, where they actually look at how markets respond to a higher likelihood of an election being won by a Republican versus a Democrat. And what they're actually doing is they're looking at betting markets to infer shifts in probability. And they actually find that when the probability of a Republican winning goes up, the stock market reacts positively. And when the probability of a Democrat winning a presidential election goes up, the stock market has a negative reaction. They estimate the overall magnitude of the effect to be at about 2 to 3% of market capitalization, shifting from a certainty of Democrat victory to a certainty of Republican victory. Girardi has a paper in 2020 where he shows very similar mechanisms extending around the world as well. Whenever right wing parties seem to be winning national elections, stock markets react positively. It's an issue that even professionals don't seem to be pricing accurately. That I think makes it even more interesting for us. It's probably time to dive a little bit into the actual evidence, right?
Let's take a look. Let's do the waterfall. Let's start at the top and talk about the economy, the stock markets, and then finally firms.
Yes, absolutely. And you're right, because there are different layers of evidence here. So we start with the macroeconomy, right? There's a very interesting paper by Blinder and Watson published in the American Economic Review in 2016, where they are actually looking at data spanning a fairly long time period. They start all the way in 1949 and they go all the
With
way
Truman, with
to
Truman.
that's correct, right? So we are really going quite a ways back, and they're going all the way to 2013. They have 64 years in their sample, and within these 64 years, one of their main findings is that average growth of gross domestic product, how we measure the overall size of the economy, it's about 3.33 percentage point per year on an annual basis, that is. But there are big differences depending on the politics of the president in power. When a Democrat president is in power, we see average growth of 4.33% per year. That's 4.33. When a Republican president is in power, we see average growth of 2.54 percentage point per year. So that's quite a significant difference. 1.79 percentage point. Now, if you extrapolate from this over a 4-year presidency, that means that on an average, under a Democrat president, we see average growth of 18.5 percentage point. Under a Republican, we have 10.6 percentage points, right, over a 4-year presidential term. Quite a big difference here. We are talking about some substantial effects.
And I
Now,
think visually it makes it very clear if somebody would pick up the paper and take a look at the graphs that they present there. They just color code the bars red and blue. I think visually this difference stands out even more.
but Kate, why would anybody pick up the paper? That's what we are here for. So they don't have to pick up the paper. And now, jokes aside, you're absolutely right. I think that it's one of the weaknesses, perhaps, of the audio model. But when you're talking about 18% versus 10%, the fact that these are pretty stark differences. And Blinder and Watson are also telling us this is not just a mean effect driven by a few outliers. One of the things that they do to try to convince us there are real differences is that they note that during their sample, there are 49 quarters of recessions, as per the National Bureau of Economic Research definition. And they note that out of these 49 recession quarters, 41 fall under Republican presidencies and 8 fall under Democrat presidencies, despite the fact that there is a similar number of years and quarters in power.
This is going to make somebody think that this better performance during Democrat presidencies is because there's more recessions that are occurring during Republican presidencies, right? It's kind of leading one in that direction. But I think what's important to point out that even if you exclude the recession years, so if you, in a way, what we say, control for the recession years, the result still stays. Economic performance is still stronger under Democrat presidencies.
Absolutely. You're absolutely right. I think that it's an important qualifier. It's not the number of recessions that's driving the results. Even when you throw those years out, you still get the same. And they do have a lot of other numbers in this paper. Some of the things that they do find is they don't seem to find big differences in terms of fiscal or monetary policy and their direct consequences. They do find some differences in the unemployment rate, but they claim they're not necessarily significant. Although they do claim that when you look at the change in employment, there are some differences. When a Democrat gets elected, the unemployment rate tends to decline. When a Republican gets elected, the unemployment rate tends to increase. But again, the differences they find are not major. I did find, however, a different study by the Belfer Center at Harvard that actually does have slightly stronger conclusions when it comes to the unemployment rate. They find under Democrat presidents, on an average, job creation at the rate of 1.7 percentage point a year, and under Republicans, it's just 1% per year. So they're finding almost a doubling of the pace of job creation under Democrats. Now, of course, this is a first layer of evidence that's macroeconomic, right?
I'm ready to jump into finance as well and talk about something that relates to stock markets.
Well, yeah, fair enough. We are finance people, and ultimately we want to make money. So we want to know, how does the stock market do? There is literature on this starting all the way in the early 1980s that is documenting that for all the past century already, we see stronger stock market performance under Democrat presidents. I'll focus on some of the slightly more recent evidence. We have a paper published in 2003.
A highly quoted paper, so it's like one of those things that everybody generally knows about in academia.
By all means. This is a paper published in 2003 by Pedro Santa Clara and Rosen Polkanov in the Journal of Finance. What they're doing is they are actually looking at the period 1927 to 1998, and they're looking at stock market performance, let's say, above the risk-free rate. So they take market returns, equity market returns, they subtract returns on treasuries to get the equity premium or the realized equity premium. And they find that under Republicans, returns above the risk free rate average 2 percentage points per year. Under Democrats, we have 11%. This is even more astonishing than the evidence that we've seen that's macroeconomic, right? You have 11 percentage point returns per year under Democrat presidents, only 2% per year under Republicans. When you see results that are this strong, it's okay to be skeptical. So you may be thinking perhaps they are cherry picking timeframes here in their analysis, selecting years in which their story holds true, or that this is some other artifact of statistics. Well, there is a lot of follow on research on this. That's the beauty of the scientific method at the end of the day. And these findings have really held to scrutiny over time. Probably the most cited paper is by Lubos Pastor and Pietro Veronesi. Their paper was published in the Journal of Political Economy in 2020. They are extending this analysis, and effectively they look at the period 1999 to 2015, and they find an even larger difference. So their bottom line number is a whole 17% per year. That is, the difference between stock market performance under Democrats and Republicans is a whole 17 percentage points. Again, under Democrat and Republican presidencies. So truly astonishingly strong results and truly robust results. We know from these two layers of evidence at this point that the macroeconomy does better. And we know from the last couple of papers that we discussed that the stock market performs better during Democrat presidencies. Now, somehow, I'm hoping you're going to help us connect stock markets to the macroeconomy by looking at firms, Kate.
Yeah, let me try. So let's now look at firms and talk about corporate performance. I have a paper on this with Esther Im. But before we jump into that, I would like to explain a little bit how stock market returns are related to corporate performance. I mean, ultimately, stock market returns go up if a firm valuation goes up, and they go down if a firm's valuation goes down. And at its very basics, firm valuation, which is what we teach in our finance classes, really depends on the cash flows of the firm. And cash flows, again, at its most basic, have two main components: operating cash flows, which really are your revenues minus costs, what you bring in minus what you spend to sell your product. And the second element is investment, or your reinvestment really in the business to maybe purchase equipment for the products that you're buying. So these two elements, operating and investment, create the core of cash flows, actually for multiple years forward in time. And then we translate those into today's dollars. by what we call discounting them at an appropriate discount rate that accounts for the riskiness of the firm and the cash flows. So basically, what I'm going to be talking about are corporate outcomes. You might think, what do they have to do with returns? Well, returns move around given changes in firm valuation. And firm valuation largely depends on these corporate outcomes related to revenues, related to sales, related to investment. So that's the link. So I wanted to mention that first. Does that make sense?
Oh, absolutely, Kate.
The question that we ask is what happens to corporate outcomes across various presidencies? We go back to Eisenhower to 1950s, and that's because accounting data becomes more available or better at that time, and all the way through 2021. So some of the more recent data. And we start out replicating or finding a result that's closely related to returns on the corporate sphere. And that's going to be what we call the market value of equity, also known as market capitalization, which is really just a price per share, a price of the stock times the number of shares outstanding. What we find is that this market value of equity, and also we look at their scaled measures like market to book, they're lower during Republican presidencies than during Democrat presidencies. So this creates some consistency with the previous literature. And then we jump straight into corporate outcomes. We start out with, I would say, the sexiest ratios on the market. And those are going to be your profitability ratios and examining firms' profitability, just because so much of valuation depends on profitability. And there's so many profitability ratios. There's gross margin, operating margin, net profit margin, ROA, which is return on assets, ROE, which is return on equity. So we look at a variety of those and we find that pretty much all profitability matrices are lower during Republican presidencies. I have to also mention that we are looking inside of the firm across presidencies. So this helps control for a variety of factors related to the industry and so on. To put some numbers to it, we find that operating margins are about 7.5% lower during Republican presidencies compared to Democrat presidencies. And ROA is about 4% lower, which is return on assets. Those are also pretty significant numbers.
I'm not sure that everybody will necessarily appreciate the strength and importance of looking at within firm effects here. And I think the way I'm looking at this, and correct me if I'm mistaken, I think that when we compare across parties, we have some preconceived notion that some parties favor certain industries, right? That Republicans might be more friendly to oil companies, and Democrats might be pushing for green energy, and that perhaps some of these uh, differences in performance might be driven by the fact that, well, Republicans are simply backing the wrong horse, right? Republicans are betting on oil and dirty energy. The world moves to green energy, and their bets don't pay out in terms of economic growth. That's a plausible hypothesis, but it seems to me that your findings are disproving that.
I think looking within the firm allows us to really zoom in on the actual effects of what's happening and concentrate on that firm level environment. So yeah, thanks for pointing out. I'm not going to be tooting my own horn, so to say, but I think that yeah, looking within firms gives you a very precise understanding of what really goes on to corporate outcomes in reality.
I guess the point that I was trying to make is that it's not just econometrics, right? It leads to cleaner econometric analysis, but there's an important shift in interpretation once we realize that this is the same firm performing differently under different presidents.
Thank you. And we've established that profitability is lower. So you might be wondering, well, why is profitability lower? Well, profitability can be lower if either sales are lower or expenses are higher, right? Because at its base, profitability is just sales minus expenses. Whatever you bring in money wise from the sales of your products or services, minus the expenses that you incur in the process of sale. The big question is why is profitability lower? We look at revenues and expenses. And what we find is that sales growth, revenue growth, is significantly lower during Republican presidencies. Specifically, we find about a 3.4% difference in sales growth from 1994 to 2021, and about 1.5% difference between 1950 and 2021. So sales growth is lower, and this is an extremely important result because sales growth influences many decisions. John Graham from Duke University has a survey of CEOs, and it's a very popular CEO survey. CEOs told him they use revenues or sales growth projections for a variety of decisions, including those on investments. For us, sales growth and revenue projections are really key to making many, many decisions. So I think this is a very important result. It's also important from the perspective of valuation because it influences future sales, the future growth rate applied to those cash flows, which is at the heart of valuations. To understand the magnitude, I mean, what is this 3.4%? Is that a lot? Is it not a lot? To understand the magnitude, we decided to compare it to what happens during recessions. We find that during recessions, sales growth is about 7.5% lower than during non recessionary periods. So, what happens during Republican presidencies at about 3.4% is half to one third of the impact that we see during recessions in terms of sales growth. So, it's an important result. Sales growth is lower, therefore, profitability is lower. But it's also possible that maybe expenses are higher. So
So
next we look at expenses.
this is starting to paint a bit of a consistent picture, right? Businesses and consumers spend less, sales growth goes down, sales growth is important to valuation. This ends up translating into stock market outcomes.
So I think this is providing a mechanism underlying the stock returns. And I agree that everything seems to be coming in consistently throughout multiple aspects. And within corporate performance, too, once you drill into it, we keep finding these very consistent results. Jumping quickly back to some of the other corporate outcomes, expenses. There's some politically motivated expenses. Politically motivated expenses that firms incur are taxes. Taxes usually are going to be lower during Republican presidencies because Republican candidates campaign on promises of lower taxes. Another politically motivated expenditure that firms are subject to are salaries because it relates to employment. And employment receives bipartisan support and interest, but generally, Democratic candidates will campaign with promises of job growth, job support, etc. Also, expenses that firms incur can be fixed or variable. Fixed ones are usually more difficult to reduce whenever you're trying to address lower sales. What we find is that indeed politicians walk the talk, so to say, and effective tax rates are lower during Republican presidents. This is consistent with Pastor and Veronese's 2020 study, also with previous research that has already documented this. So we're not opening anything new, but we're just showing, yes, that within the firms, we also see these results. Taxes are indeed lower. But remember, while taxes are lower, we still see lower profitability, meaning that this lower tax rate, this lower expense, is unable to offset the lower sales that I experienced during Republican presidencies.
I think that this is a point worth pausing on for a second, right? Republicans really are the party of lower corporate taxation. And despite that, firms seem to underperform, right? So if we just go by this result, it's a bit of a lose lose. I mean, we are losing in terms of corporate payouts and distributions to the private sector. We are losing in terms of public sector financing, right? I mean, we have lower tax revenues. This does remind me, Kate, that we should have mentioned upfront that we try to stay apolitical, right?
Definitely. Yes, we should have definitely mentioned that. We really are looking at academic research out there and the data. So we're trying to stay as apolitical as possible. While I'm discussing my paper now, I have another paper that actually finds better innovation outcomes under Republican governors. We are trying to just present the outcomes and the data here. You're right. That's a very important point.
In some sense, it's almost unfortunate that as we are trying to stay apolitical, if you will, in this paper, there are such strong effects that you're having a hard time not using hyperbole. Some of these numbers are truly, truly massive and hard to ignore.
Yeah, I agree. I agree. So let me throw out a couple of other big numbers here. It's interesting to look at what happens to employment and therefore the salary expense across presidencies. So what we find is that employment growth is lower by about 5.1% during Republican presidencies as compared to Democrat presidencies. What that means is that firms can pay less in salaries, so their salary expense goes down. So firms see lower tax expense and lower salary expense under Republican presidencies. But when we look at their overall expenses, we see that those are still becoming a higher proportion of their sales, meaning that the reductions in taxes and salaries is not enough to offset the lower sales. And we see that profitability continues to suffer. So there's lower profitability due to lower sales. We see some reductions in certain categories of expenses, especially those that are politically motivated, but profitability continues to be lower. And we find that this first big important measure of these cash flows, which is the operating cash flow, is lower during Republican presidencies. And specifically, it comes in at about 6% lower. If you compare that magnitude to recessions, during recessions, it's about 15.7% lower. So, again, about a third of the magnitude for operating cash flows during Republican presidencies as compared to recessions. So that kind of summarizes this first big element of cash flows. The next thing is investment. Because if cash flows are lower, firms could offset them by lowering investment and then keeping their cash flows intact. We actually see that firms do that. Remember, managers mentioned to John Graham that they use sales growth as their guiding principle for many decisions, including investment. So, what is investment? Investment is a firm buying equipment, building factories, also participating in acquisitions. And it really influences the firm's total assets or the physical size of the firm. This investment element is an important component of firm's total assets. We find that investment is lower during Republican presidencies. When we look at capital expenditures, we see that they're 11.6% lower. We also find lower acquisitions, again, consistent with this lower investment. And all of this actually points to firms shrinking themselves or reducing their total assets. They do shrink themselves by about 5.3% during Republican presidencies as compared to Democrat presidencies. So, investment in tangible items is lower during Republican presidencies. Well, but what about intangibles like research and development? We didn't see any significant differences in R&D growth across presidencies. So it's quite similar across Democrat and Republican presidencies at the big scale. Besides operating cash flows and investment, operating activities are important for firms too. Things such as inventory management, management of customer payments and supplier payments. And when we check those, we don't find significant differences across time. Altogether, we see reduced operating cash flows, reduced investment, and when we look at firms' cash holdings, firms' liquidity, we actually find that liquidity goes up during Republican presidencies, and firms hold a higher proportion of their assets in cash during those times, somewhat of a flight to safety, as you might. This summarizes some of these operating cash flow investment outcomes that we found. I have to say that we are looking at contemporaneous outcomes. We also would, as you say, lag some of our control variables. So we ensure that these results are really specific to what we're looking at, not kind of the other way around.
Yeah,
And yeah.
in many ways, Kate, you beat me to it. I was just gonna ask you, Are you guys thinking about w- the chicken and the egg here, right? Is it that sales go down and then firms are cutting everything they can cut to stay afloat? Or are firms in some way less optimistic about the future, so they are investing less, and that translates into future lower growth? Or is this again something that we cannot disentangle?
Yeah. It's the sales growth, the slower sales growth that's an important factor here. And that's why I was saying also earlier that that's quite important. So, sales growth is lower during Republican presidencies. Sales growth influences your future projections as well. What's important to point out is that valuations oftentimes depend on the expectations of future corporate outcomes. But we are recording a lot of contemporaneous, very consistent evidence, nonetheless contemporaneous. We do have one window of looking into the future where we can look at analyst projections of what's going to happen to the firm over the next year. When we undertake that analysis, we see that firms' expected earnings are projected to be lower in the following year for under Republican presidencies as compared to Democrat presidencies. So we also find some consistency with future cash flows for our results. To summarize, if you look under the firms, you find lower sales, lower profitability, lower investment. These are consistent with them being mechanisms for lower returns documented by Santa Clara and Volcano in 2003.
And all of which you're citing is under Republican presidents, right? When you're
That's
saying
correct.
lower,
That
lower,
is
lower.
correct.
A very consistent picture, the macroeconomy, the market, firm level evidence. And frankly, I think that it's hard to not be convinced by the bulk of the evidence. Right? I think that what's more controversial here is trying to explain why, right? Why are we seeing these kind of big numbers?
I think that is a big, interesting question. What can explain all of this? What are some of the explanations?
Absolutely. And so let's dive a little bit because all of these papers all try. Now, we're going to see by the end of this discussion that perhaps they don't necessarily succeed in explaining what's happening, but let's dive into what they're telling us. Well, first of all,
Let's look at explanations.
absolutely. So, one of the things that we keep hearing as a possible, let's say, objection slash explanation to what's going on is, well, you might be just cherry picking your time periods here, right? That perhaps this evidence is based on finding the right window of time during which the results hold. I will say that first of all of this research is based on fairly long samples. So first of all, that already seems to disprove some of these cherry picking allegations. I will also note that most of the research that has extended the initial studies has found very consistent results. For example, Blinder and Watson, they're looking at 1949 to 2013. They're finding this big GDP growth advantage. But then the EPI has recently published a report that extends this to 2024 and finds comparable, if not slightly stronger, effects in terms of the economy. I will also say that as I was preparing for this discussion, I did decide I'm going to dig a little bit and let's see if I can find any evidence that contradicts this main narrative, right? And I did actually find one article published in an online outlet called The Hill.
So hold on. I am going to show my total ignorance here. I am unaware of the source.
It's an online magazine, it's an online publication that focuses specifically on US politics. And so, Kate, it is not a peer reviewed journal, if that's what you were going to ask. But they make a point, and perhaps it's worth looking into. They actually had a headline that attracted my attention because the headline said, the US economy does better under Republican presidents. And I was like taken aback by this being so contradictory to what we're talking about here. So then I went to look into what they're actually doing, and they're looking at GDP, but they're dropping everything prior to Nixon, prior to President Nixon. So they are starting at a later point. And now they don't offer any raw numbers, So I couldn't quite replicate their conclusions. I crunched the numbers on my own. And truth is, yeah, when you look at from Nixon onwards, you actually do find a very slight Republican advantage.
You are talking about the economy and about GDP growth. If you're going to look at stock market returns from Nixon forward, you will still find that stock market returns are stronger under Democratic presidencies than Republican presidencies. So if you're looking at stock returns, they'll still be worse during Republican presidencies.
Oh, you're absolutely right, Kate. One constant here is that all the results are strong, but the stock market returns are the strongest and most robust. Right? Well, I, I actually shouldn't say that. Compared to the macroeconomic results, the stock market results are stronger and more robust. I don't know about firm level evidence. That's certainly more your domain than mine. But I will say so. If you start at a slightly later time period, the GDP growth and GDP results seem to become a little weaker or not significant, maybe even flip signs. But still, the stock market is still painting a very, very consistent picture of stronger performance under Democrats. Does the window that we choose matter? To some extent, it does. Blinder and Watson themselves ultimately conclude that lucky timing has at least something to do with it. In particular, they talk about two sets of events. They talk about crude oil shocks and the timing of crude oil shocks in the 70s and 80s having favored Democrat presidents.
Crude oil prices were lower during those times.
I
They're going to
presume
say these were more benign crude oil shocks during Democrat presidencies.
absolutely. And there are shocks that, in some sense are coming from the outside, right? I mean, if a crude oil shock is tanking your economy, it's bad luck, right? In some sense. Perhaps oil is not entirely exogenous to American policy.
This is a whole other episode. I think that's the case in the more recent time frame. Since 2010, oil production has become extremely important in the US. But we're looking
Absolutely.
at a really long time frame here. So yeah, it's true. Oil shocks or crude oil prices are lower during Democrat presidencies. That's what seems to be one of the explanations. And the second,
The second is the Korean War. They find that the Korean War had at different points of time both benign effects on the US economy by stimulating demand and negative effects by imposing fiscal pressures. When you look at the timing of these shocks, it seems to have favored some of the early Democrat presidents, and it seems to have really, really affected negatively some of the early Republican presidents. So, in some sense, what Blinder and Watson are concluding is that this fortuitous timing of the Korean War and the oil shocks has, to at least some extent, favored Democrat presidents. But I will also say that ultimately, it is early on in our sample. It's really when you're in the Truman years, in the Kennedy and Kennedy Johnson years, that you're seeing some of biggest differences in Republican versus Democrat performance from a macroeconomic
right,
standpoint.
I was just going to stress, we're not talking about the stock market here. Stock market results remain very consistent,
I know.
consistently lower during Republican
I,
presidencies.
I was ready for your objection, Kate. I was ready for it. But anyways, I don't know where we rate this time period window cherry picking. I wouldn't call it a valid explanation for the results, certainly not on the stock market, but there is at least some.
Pointing to a bit of this lack explanation, especially with crude oil, right?
Correct.
Yeah.
But Kate, there are other papers here that are telling us that this is not necessarily about the lack of economic performance, but it's lack in terms of
Yeah.
the economic situation you've inherited, right?
I've heard this asked from me a lot. People say, well, it's very possible that the policies from one administration are passed on to the next administration. So this lead lag possibilities, these high growth policies from a previous administration are now enacting or reliving themselves in the new administration.
Democrats are just benefiting from the smart policy of the Republicans coming before them. That's
That is correct, yes. This has first been addressed by Blinder and Watson in their 2016 paper. So they dissuade that ideas that lead like possibility because they show that the inherited growth by Republican presidents is about 4.25%, while that by Democrat presidents is about 1.94, close to 2%. So Democrats inherit lower growth rates. When we take a closer look at corporate outcomes, we find that corporate outcomes are the lowest during the second and third year, the middle years of the Republican presidencies. This is consistent with Bello, Gala, and Lee 2013, who find stock market returns to be lower again during the middle years of Republican presidencies. So that kind of helps dissuade a bit of that lead lag association and inherited conditions. So I'd say that's probably not the explanation.
I will say that this puzzle is a tough nut to crack, right? It feels to me that every time we come up with an explanation that we start digging into it, it seems to lead to an even deeper hole because we can hypothesize Democrats inherit better conditions, but then we look at it and Democrats inherit worse conditions, and despite that, they do better afterward. And instead of getting an answer to this puzzle, right, the puzzle just seems to be getting even more puzzling.
I think the next thing in this puzzling puzzle we're going to talk about is risk cycles.
Yes, absolutely. And I think what you're hinting at here is the Lubos Pastor and Pietro Veronesi story. They had a paper published in 2020 in the Journal of Political Economy. And this is mostly a theory paper with some empirical evidence in support, but it's mostly a theoretical paper. And they're trying to provide an explanation that relies on the idea that risk aversion changes over time. And they claim that risk aversion correlates both to electoral outcomes and with stock market outcomes, effectively inducing some sort of spurious relationship here, right? So let's walk our way back. You know, there's some big words here. So let's look at what they really mean. First of all, risk aversion is a metric of how afraid we
Yeah.
are, you know,
It's an attitude towards risk.
thanks for bailing me out there, Kate. Pastor and Veronesi are telling us is that when risk aversion is high, when people are concerned about the status of the economy, they tend to vote Democrat, right? And again, here, Democrats are the party that in general promises higher levels of distribution, stronger social safety nets, stronger welfare programs. And there's some evidence that people value those more when things get rough, right? At the same time, when risk aversion is high, we have a very large asset pricing literature showing that subsequently corporations have to offer high returns, right? And again, the logic here is that when people are afraid, you have to offer them higher returns to incentivize them to invest, right? So effectively, after a spike in risk aversion, subsequently we see higher returns on markets. You have this higher risk aversion, Democrats get elected, and subsequently the stock market does better. If you buy this Pastor and Baronesi story, this relationship has nothing to do with actions taken by Democrat politicians. Rather, it's just spuriously induced by the fact that risk aversion correlates with both electoral outcomes.
This is an important explanation that they provide, but I would like to say that it is a theoretical explanation. And they do have some empirical findings there in their paper to support their theoretical explanation. But they mostly look at the periods of transition in terms of presidency. So they're not looking at full presidential cycles there. They're looking at transition periods. But yeah, important explanation, theoretical explanation largely. And the empirical evidence is mostly on the transition side, not on full presidential cycles.
And then I will say that they do extrapolate from that. They try to generalize the results, but you're right. The evidence is coming from transitions. Now, there's something else about this paper that I won't say bothers me, but I find this paper fairly convincing when it comes to explaining what's happening with stock markets. The problem is that while it explains that piece of the overall puzzle, I still fail to understand how these higher levels of risk aversion are actually leading to better real world outcomes. Why is the macroeconomy doing better? Why are firms doing better? I understand the market offering higher returns, but if anything, higher risk aversion to me sounds like higher cost of capital for firms, and higher cost of capital generally means worse performance down the road. They do have a section of the paper where they claim their model explains what happens in the real economy, but I have to admit that I'm just not smart enough to truly follow. And I have to admit that I haven't been fully convinced.
Well, I think it's an important explanation, saying that this could be just a spurious result. Other typical explanations are going to be policy based, as there are certain policies undertaken during Democrat presidencies that can explain the result. And finally, the last explanation is overconfidence, or so to say, euphoria. Perhaps that can explain the findings that we've discussed. Let's jump to the policy explanation. Is there something fundamentally done better from a policy side under Democrat presidencies? Multiple papers have looked at Congress because oftentimes Congress is perceived to have more power than the president. And perhaps the results are due to a Republican
And
or
we should probably
Democrat
say
Congress.
economic power is probably what you mean.
Right, right.
And I think that this plays to, I mean, we know that the power of the presidency when it comes to economic matters is limited. I think it surprises most observers, or at least it surprised me, how strong effects we are seeing here with the shift of president when we know that the president is only one of the agents determining economic policy.
Several papers have looked at Congress because of that. Blinder and Watson is one such paper, and they do not find that Congress can explain better GDP growth, higher GDP growth under Democrat presidencies. I have looked at it from a firm
I'm
outcome
sorry,
perspective.
when you're saying Congress can't explain,
They're looking at political alignment between Congress and the White House. So you can either be politically aligned or have a divided government or misaligned government when the Congress and the president are misaligned politically. So they find that both periods of alignment and misalignment see worse performance with Republican presidents. This is been explored before by Alberto Alesina, Alesina Rosenthal back in 1995. Explains this idea that divided government or misaligned government, or whenever Congress is not of the same political party as the president, allows for milder policies to be implemented, more balanced policies to be implemented, and the economy benefits from that. And if you look not only at the economy, but down inside firms, what we see is whenever there's misalignment between Congress and the president, corporate outcomes are indeed better. And that's true for both Republican and Democrat presidents. So political misalignment between Congress and the White House seems to benefit corporate outcomes and be better for firms. Nonetheless, this doesn't explain the lower corporate outcomes for Republican presidents because we continue to find lower corporate outcomes for Republican presidents, even when accounting for congressional alignment. So this was an interesting policy result. Nonetheless, it doesn't provide an explanation for the puzzle. So another thing to look at here with policy is perhaps some industries are politically favored. For example, industries that receive government contracts might benefit more under Democrat presidents. And there's actually a paper by Bello, Gala, and Lee, 2003, who shows that indeed stock market returns are better for firms with more government contracts. And that's more specific to Democratic presidencies. But when we look inside of the firm and their corporate outcomes, again, this is back to sales, expenses, profitability, and investment, we don't find that corporate outcomes for firms with more or less government contracts differs that much. No matter how many government contracts a firm has, they see lower corporate outcomes during Republican presidencies. Besides firms and industries with more government contracts that could be policy influence, is those firms that produce more domestically or firms that perhaps export more. You would think that firms that export more are less subject to domestic policies and perhaps see different outcomes. When we check firms with different levels of exports, we see that all of them with higher or lower exports still have worse performance during Republican presidencies compared to Democrat presidencies. So, again, not much of an explanation there. Interesting outcomes, but not really an explanation there.
And I will also say that I keep hearing this hypothesis that all of this is somehow something to do with trade. But I think it's based on a bit of a fallacy. Mm, people are approaching this as well, since Republicans are so much against trade, and since we have all this evidence that trade makes
Yeah,
Mexico.
that's a loaded statement there, right?
It
Because if
is.
we look back to Bush Jr., he was very pro trade.
Yeah, I mean, that's exactly where I was going with this. In some sense, we've had a bit of a regime shift under the Trump administration, where we started seeing Republican hostility to trade and international commerce.
It's completely opposite of what was there with the previous Republican president, George Bush.
Correct. And if you go back even further, Democrats had their own regime shift in the sense that prior to the 90s, Democrats were the party that was valuing union labor,
Mm.
domestic employment.
Clinton was very open to globalization and trade.
Correct. So I think that for our younger listeners, it's easy to think of Democrats as the pro-trade party and Republicans as the anti-trade party. But from an historical vantage point, that's utter nonsense, and that cannot
Yeah.
possibly explain what we see here happening in the past century.
It seems like these policy explanations are super interesting, but not quite providing an explanation for the presidential puzzle. What we do see is that policy does provide some explanation at the state or at the gubernatorial level. There's a very significant policy effects associated with Republican governors and Democrat governors, where Democrat governors are usually associated with more spending on education and healthcare, and Republican governors are usually associated with more spending on infrastructure and parks and recreation, hunting facilities, etc. So that definitely exists at the state level, that meaning the policy explanation. But then when you drill down to a finer level at the city, mayor's political affiliation doesn't seem to explain anything. So we think that there could be a possibility with a presidential explanations related to policy, but we can't really pinpoint what it is. Those are interesting findings. But there are some results at the state level. So while the policy explanations are interesting, they don't provide the total explanation for the puzzle. And then there's also labor policies, right?
Clearly, there are very different political priorities here when it comes to labor between the two parties, and those could in some way shape ultimately productivity. And we know productivity leads to wealth and growth. Blinder and Watson dig into it a little bit, and they have some numbers that seems to suggest that total factor productivity is slightly higher under Democrat presidencies than under Republican ones. But they put forth a strong disclaimer saying the results are not strong and not statistically significant at conventional levels.
Right. And it's tough to disentangle. I also saw some evidence showing that blue collar workers actually work more hours during Democrat presidency. So is it really productivity or is it a certain number of hours? Uh, but
I mean,
but the question is, if there was a better safety net provided, would people work harder? That's kind of what we are thinking here.
it's an intriguing hypothesis, right? Neither of us is a labor economist, so I don't exactly know what the literature says. But I have always been under the impression that most of the economic literature relies on incentives, both the carrot and the stick, as driving productivity. The idea that uh, you can provide greater safety nets to people, lower the level of risk, and that will somehow lead to higher levels of effort and productivity, that's not entirely consistent with how most economists think about this. From a human and even psychological intuition standpoint, you could see how somebody who's less worried, less afraid from the future, perhaps, is a little bit more efficient and productive.
Right.
And yet,
Well,
those are at best hypotheses.
right. So let's switch it and talk about one more possible explanation for the puzzles that has been examined, and that's over optimism or euphoria, so to say. There's been recent literatures that examines this really a behavioral explanation in a way where people feel more euphoric, more optimistic about the future whenever their party representative is in power. And it comes through in multiple ways. So people actually have more children whenever their presidential party is in power. Analysts will rate the same company differently. So, if you were, for example, a Democrat analyst and I was a Republican analyst and we were rating the same firm, you would give it a higher ranking if the president in power was aligned with your party, even though we're looking at the same firm. So this kind of shows that people are indeed more optimistic whenever their chosen party is in power. There's me and Sufian Khashoggi 2023, the review of economic statistics, who questions that somewhat. They indeed look at the Gallup data and finds that Gallup data strongly shows more economic optimism about future performance. Specifically, they show that Republicans report higher spending after the election of Donald Trump in 2016. Again, they are just reporting it. But when they look at the administrative data, actual spending patterns, they find no evidence of increased spending along these political partisan alignment lines. So, is it just talk or is there actual action behind there? Who knows? But it will be interesting to look at this explanation because then you would think that areas that are politically aligned with the president and firms located in the areas that voted Democrat for a Democrat president or Republican for a Republican president would see better outcomes, more sales during this political alignment. We took a look at this, and basically, what we find is that likely Democrat firms have worse outcomes during Republican presidencies. They have lower profitability, lower sales growth, and lower investment as well. So far, so good. It's going right along this euphoria explanation. But what we find is that likely Republican firms located in those areas that vote Republican, also see worse outcomes during Republican presidencies. They also see lower sales growth and lower investment. This explanation is only partially supported, so to say, by data, but results are interesting nonetheless.
Yeah, I would say two things come to my mind when I hear about this over optimism or euphoria type of explanation. One is it seems to contradict what Pastor and Veronesi are saying, right? I mean, Pastor and Veronesi are finding greater degrees of risk aversion to correlate with Democrat presidencies, which, again, risk aversion is not the same as pessimism, but for all practical purposes, I think they correlate highly, right? And the other thing I will say about this optimism euphoria explanation is that for it to really explain why the economy is growing at a faster pace when a Democrat is in power, you need to assume that the majority of electors are Democrats. I know that the popular vote has been favoring the Democratic Party over the last decades, but I'm not sure that was necessarily the case in the past century.
Yeah, so let me summarize a bit. What we've discussed here today is that economic outcomes, GDP growth, stock market performance, and corporate outcomes such as sales and investment are all lower during Republican presidencies compared to Democrat presidencies. There have been a number of explanations examined for it. We've listed some, but it's really a long list. It's not outliers. It's not the monetary or fiscal policy. It's not lead leg. It's not the Congress. It's not unemployment. It's not the wars. It's not some industry affiliations. It's not firms' alignment with presidential economic approval rating. It's not risk aversion really there. There's some evidence for a more benign crude oil shocks, a bit on worker productivity and consumer optimism. But we're still lacking a strong explanation for these very consistent results for economy, stock markets, and firms across presidencies.
Absolutely. When I walk away from it, I think that lucky timing and the crude oil shocks that you mentioned has definitely something to do with it. Otherwise, there seems to be something behavioral under the surface, this optimism that leads to higher levels of economic activity. Ultimately, Kate, I think we do have to recognize that when it comes to explanations, uh, we don't have a nice, elegant statement of what exactly is going on here. Am I Is that a fair conclusion?
I think so.
If we cannot ultimately come up with an explanation, does that mean that we cannot fundamentally establish causality here?
Uh, Petrovsky 2017 has a good review, and that's one of his biggest criticisms of these studies on presidential parties, Democrat and Republican, is that it's very difficult to establish causality. There's not too many exogenous changes here. So I guess this leaves us in a search of an explanation still for the result.
So we cannot really say that the Democrat president is causing better economic outcomes, right? But at
We
least
just
one
know
thing,
that they exist.
correct. But at least one thing that we can do here is ruling out the alternative hypothesis that a Republican president causes better economic outcomes.
They just don't exist.
We are not seeing that. Okay, fair enough.
I'm going to throw in one more question on top of our unresolved puzzle. The puzzle does show very strong economic results and stock market performance during a Democrat presidency. So that leaves me wondering what can explain Republicans' electoral success when economic performance has been documented to be better under Democrats.
And we know that the economy matters to electors, or at least that's what they tell us. So there is here a bit of a puzzle also in what explains Republican electoral success. At some point, we do have to recognize that Republican policies or outcomes under Republican presidents perhaps do not lead to better economic outcomes for the country as a whole, for workers as a whole. It is entirely possible that Republican policies lead to better economic outcomes for the rich, the wealthy, the powerful. When you lower corporate taxes, the people who tend to benefit are the shareholders, and shareholders are people who are wealthy to start with, right? Uh,
Well,
so
share ownership in firms has become a more widespread phenomenon over the last few decades.
fair enough. If share ownership is more widespread, that doesn't mean the rich don't own more shares as a proportion of their overall wealth. Nevertheless, perhaps that's not the right road to go down because corporate outcomes are not better, right? I guess what I'm really pointing at is that perhaps the fact that people with higher levels of income have unequal levels of political power has something to do with the fact that Republican economic policies are still not being penalized.
Fundraising is a significant part, perhaps related to advertising or some type of marketing and so on. Yes.
Yeah, I think that, as we were saying, individuals do not have equal political power, right? Money matters, and that translates into fundraising. But somebody like Elon Musk has influence that goes beyond the pure economic, right? He owns formerly Twitter, now X, which allows for changing some of the messaging. At the end of the day, we have this episode on the presidential puzzle. What we are asking is, why are people still rating Republicans as better stewards of the economy? So if you're asking why is it that Republicans still do well electorally, even though the economy doesn't necessarily do well under Republican presidencies, I think one piece of the puzzle here is most people simply do not know, right? So I would say, Kate, let's see if this changes after our episode.
We'll see, we'll see. But you were talking mostly about the richer part of the population, providing some financial support for the Republican Party. In a very puzzling manner, I'm going to switch out and go to a completely opposite set of population here. And what's very interesting is that areas that have really suffered severe job losses, areas that have been significantly hit with losses of jobs related to free trade, the manufacturing jobs lost to factory closures, coal mine workers, steel workers, those experiencing severe job losses due to this more open and free trade. Actually, those areas have been leaning in their votes very Republican. So here you're looking at a very different segment of a population, perhaps with lower education, that has still chosen to vote Republican. So that's a really interesting puzzle. And I think a lot of it is going to bring us into a whole other topic of party identity. Party identity is actually seen as a form of social identification, and it's an emotional connection to a political party. What's even more interesting, this party identification is more stable, or so to say, trumps the principles of equal opportunity, limited government, traditional family values, and even moral tolerance. So it's a very important identity for people. There's been a big shift over the last 20 years, even 10 years, which has brought us to changes in political polarization. We have seen a big increase in polarization in the US starting around 2010. So the topic of partisanship, polarization, and populism is really interesting, and it belongs in the area of party identity.
But what I get from this is that part of the story is that people don't just vote on the economy, and that I think over time, increasingly social issues are becoming important. But I will also say that once more, at the cost of sounding like a broken record, I do believe that somehow Republicans have done a better job at selling their side of the story. The fact that people still rate the Republican Party as better stewards of the economy, at some point we have to recognize that they've just done a better job at convincing people that that's true.
Yeah, I think so.
But
I think that to summarize things, we've given our listeners ample ground for a good dinner conversation. What do you think?
I hope so. I certainly hope so. But I will also mention that what you were talking about at the very end, this emergence of populist politics or re-emergence of populist politics in the United States and these increased levels of polarization are, of course, political science topics. But we've seen over the last 10 years a lot of research showing strong economic consequences to increase polarization
And
and
populism.
and populism as well. And I think that those would make for extremely interesting future episodes and extremely interesting conversations for us going forward. To our listeners, stay tuned for our future episodes. This is the moment in the episode where we should invite you to like us, to subscribe to our podcast. But I will admit, we don't exactly know what we are doing here. So click on something, like us, love us, hug us, subscribe to
Listen
us
to us again.
by all means. And if you can find a way to give us money, we would really appreciate it. And stay tuned for our future episode. Cheers.
Cheers.